Well, hi, it's Chris here from Capital Counts and welcome to our first interview for 2025. 2024, 2023, great years, impressive years, equity markets. The S&P 500, for example, was trading under 4,000, it's now trading around 6,000. The All Ordinaries Index was trading around 7,200, is now trading around 8,500. So the big question for all of us is, where do we think markets will be by the end of this year? Today I'm hosted by Antipodes, a global and emerging equities manager, managing $18.5 billion, and I'm kindly joined today by one of their portfolio managers, Vihari Ross. Welcome, Vihari.
Thank you, Chris. Very happy to be here.
Thanks for having us. Vihari's got vast experience, had 15 years at Magellan, and has also run a research team comprising of 13 individuals. So I think you're pretty well placed to talk to us about all things economic at this stage. My first question, and love to hear your insights today, certainly about how markets will behave this year, is we're obviously coming off the back of 2024, remarkable returns for our clients. What were the key drivers of those performances?
Well, look, 2024, we haven't had such a strong run in markets, cumulatively for a very long period of time. But what we started to see in 2024, and it was sort of an extension of 2023, was that excessive concentration that started to build up in markets. And what we mean by that is that, the top 7 stocks delivered over 60% return, and everything else, the other 493 in the S&P 500, delivered closer to 10%. So you've got more than half of the return of the index, about 25%, coming from just those biggest stocks. And those top 10 stocks are now over 30% of the US market, and it's actually never been that concentrated. And so what you tend to see as markets, go through those bull runs and they start to get to the peak, is you tend to see that level of concentration accelerate and then ultimately dissipate. So, looking at 2025, we're really on the cusp of that. How is that concentration going to dissipate this time around? Because guess what? It's happened before. Every decade at least, you get market concentration and you get concentration of returns. So it always actually unwinds in the same way. Mm-hmm. And the first way is that the expensive stocks fall, even if they're good companies. Mm-hmm. And the second way is actually a catch up, is that all of, the sort of the other side of the coin when markets are so concentrated is that there's a whole bunch of stocks being left behind and they start to participate in returns. You actually get a broadening out of the sources of return and the sources of alpha. And that's actually what I'm expecting to see in 2025.
Okay. Donald Trump, his second term pending. What is the impact politically, geopolitically, economically with his second term?
Yeah, I think that's a very, yes, unless if he does a Xi Jinping on us and, is there forever, which is highly unlikely. But look, Trump is a big wild card. We saw Trump 1.0, but he inherited a strong economy. He inherited a rate cutting cycle. We're in such a different place currently than what we were back then. I think there's a few key things though that we know that he's talked about. Obviously, trade tariffs. I think that's interesting because it's an extension of where the America First economy has been going for a long period of time. But ultimately, by the time you get rid of cheap workers and, with the migration policies, you put tariffs on, all of that stuff is inflationary. Mm. And it could actually destabilise this, this balancing act that the Fed's trying to execute around, okay, we've got employment was weakening, now it's strong, inflation looked like it was being tamed, but you can see that it's there, on the surface, and it stayed stickier than what anyone expected. And I think a lot of these Trump policies may create a bit of a dilemma for the Fed in terms of how to progress. And we've already seen it's probably going to put a bit of a dampener on that rate cut cycle people started to expect in the US. Mm. So I think there's that. I mean, there's a lot of other things around regulation. I think you'll have a lighter hand. That might be good for a lot of companies.
And you control the Senate.
Control the Senate, exactly. These things make it easier to make change, but you still need that 2/3 majority to do a lot of things. So I think a lot of the things maybe people are scared about maybe end up being not such a big deal, maybe around healthcare, around green energy. But other things, will be enacted and actually probably create risk around the US economy, and particularly in the context of the fact that the US market is priced for everything to be fine.
Record highs, you just mentioned, the mega caps and the tech stocks, the Amazons, Nvidias, et cetera, obviously driving return out of the market. So, and like a lot of clients that actually ask that might hold some of those stocks directly. Do you actually see that trend still continuing, or a bit like what you were saying before, the other catch-ups?
Yeah, look, I think, what you tend to see first is the catch-up tends to happen first before the catch-down. And it really does become a stock-by-stock question, because if you actually look at what the biggest 10 companies in the world were, over a 5-year cycle or a 10-year cycle, they're not the same 10 companies. No. There's a shift that takes place because of technology change, because of disruption. And I think the interesting thing here with AI, which is driving these big stocks, is the amount of capital required to build AI is immense. It's sort of each company spending to get to the next tier that's slightly better than the prior is, more than $50 billion each. Yep. So you've got to pay to play in this space. And, if you think of, even if you think of the internet era, Microsoft, Intel, Cisco, those companies were amazing companies. They were successful. They generated a lot of cash. They were just expensive for what they were. It's not that they weren't instrumental in building the internet. They were, but they were expensive for what they were. And the big megas that we're now talking about, they came, a decade later. Yep. They were built, on the shoulders of the infrastructure that those companies build. And I think some of the leaders of the future might not even exist yet. But with these companies, you can see they're extending their advantage because of that capital advantage right now, and it is a little bit of a race. I think what we need to think about stock by stock is what's priced in and what isn't to each company. And case in point, we have shares in Alphabet, because that's a company that people started to write off very quickly, saying, "Oh, search is actually going to be disrupted." Actually, it isn't being disrupted, and actually they have a lot of investment in their own AI capability. So sometimes companies are being written off when they shouldn't be. Other times, like in the case of Nvidia, which we don't own, it's being priced for extraordinary success and no competition and no cycle. And so we see that where the risk reward actually doesn't make sense. But in others, it absolutely does.
From an Antipodes perspective, what sectors or thematics or individual stocks do you like or not like?
Yeah, so I think we certainly are very interested in that AI supply chain. What we're looking to do at Antipodes is, pay the right price for the growth profile and the resilience of a business. So what we tend to find when there is a big structural change like AI is that you can invest across the value chain to participate, in something that, maybe in parts of the market there's a lot of exuberance. And, a good example of that is the Alphabet example I already gave you, but also companies like TSMC that used to be, produces the leading edge chips. They have a virtual monopoly in producing those. They supply Nvidia, and that's a company that used to be very cyclical and has become a structural grower because of this investment cycle in AI. And it's a company that's now growing at 25 to 30% per annum, has pricing power because of the uniqueness of what they can do, and is trading at a less than 20 times multiple in comparison to, obviously the Nvidias and so on of the world. So that's an interesting sort of part of the supply chain we're interested in. We're also very interested in the energy transition. If you actually add up the amount of investment that's going to take place to move towards green energy, not just in the US, Europe, but also in emerging markets. China is a huge investor in renewable energy. That actually completely dwarfs AI in terms of the size of the investment.
Is there a particular stock
and
you
hold in there? And you can play that in lots of different ways as well. So we have our, you'd call, enablers, companies that are going to, that provide technology, companies like Siemens Energy, that produces wind turbines, companies like utilities, like AEP. We also have companies like Hyundai. Believe it or not, hang on, that's an auto manufacturer. Very much a leader in hybrid technology, which is where we're moving. So again, you can invest across that supply chain. Even things like, Alcoa, which is, an aluminium producer. Guess what? You actually need that in order to achieve this shift. And it's sort of really tapping into the various ways that capital is going to be spent in making that structural change happen. So there are a few that we're quite interested in.
Okay. Just domestically, interest rates, they've sort of held firm, 4.35 since November 23. What are the implications of equities from a falling perspective, but also if inflation ends up being stubbornly sticky, inflationary, what you were talking about before with the Trump factor, and it actually goes back up? What are the implications on either way?
Yeah, no, I think that's a really important question, because it is remaining stickier. And part of the issue here, and this is part of the problem that central banks are facing, is you're crushing a certain cohort of the economy, the renters and the people with loans and the people with lower incomes, in order to bring the total down. And meanwhile, the people who are net savers, a lot of people who are retired, people who own their own homes, they're just loving life. They've never, rates not been this high for a very long period of time. So they're then driving inflation through spending more than they ever have before, and it does create this difficult balancing act. I think what you have found is that inflation is stickier. Employment most recently, has come out stronger. And what that does is, again, it depends what's priced in. Of course, I would say that. But what that means is if rates are going to stay higher, that's not necessarily good for the valuations of growth stocks, which have run really, really hard, and maybe where either that growth is going to prove to not be sustainable, but also the multiple has become stretched.
Yep.
And the cash flows are just further away. So that's a risk. And the other area that of vulnerability is essentially companies that are highly geared. And there's a pretty decent swathe of the US economy. Private credit's become a boom sector. It's taken a lot of the riskier loans away from high yield and leveraged loans, and it's taken it away from the commercial bank space. And there's a vulnerability there. They're holding out for rate cuts so that they can live to fight another day. And I think if you don't get that cycle play out probably as steeply as what people predicted, you actually could start to see a bit of a default cycle play out there as well. And that clearly has implications for the broader economy.
So, final question on the spot: are you more optimistic or pessimistic about 2025?
I think I'm circumspect. I'm being an equity investor, we have that natural sort of optimism,
of course.
I think. And I think what I would say is that this dispersion that we have in markets and that level of concentration, as much as I've sort of described it as a risk at the index level, what it actually means is there's a huge swathe of opportunity at the same time in value stocks, in defensives, in cyclicals that have been left behind and that are priced. It's almost like people are a bit schizophrenic. There's exuberance in this part of the market and there's a huge amount of pessimism in the rest of the market. And there's actually a lot of value to be found for those, willing to look, beyond those mega cap stocks. So from that perspective, I'm very optimistic because there's incredible investments to be found around the world right now, including outside of the US and in emerging markets as well.
Well, there you've had it, the final word from Vihari Ross, PM from Antipodes. If any of you would like any additional information on Antipodes as a company or like to update us on your individual financial circumstances, as always, give us a call on 1300 882 166, and hope you have a very, very good year. Thank you, and thank you, Vihari.
Thanks, Chris.